Hey everyone, how's it going? In today's video, we're going to talk about 6 travel stocks to consider buying in your stock portfolios this year. Now, if you like this kind of content, be sure to give this video a big thumbs up throughout it and consider subscribing to the channel as well. We do lots of videos like this. I want to start with number 1 being Airbnb because I think their stock chart really does exemplify the swings in the travel industry this year in terms of stock prices. So you can see beginning of the year was down under $100, skyrocketed up to 140, then trended down back to 100, then up to 150, then down to the teens. Now we're on the way up again late in the year. Airbnb's at $130 a share. This is really indicative of the broader travel market in the last year, with continuous concerns of consumer discretionary spending potentially impacting consumers' ability to travel. The travel that happened after the pandemic not being sustainable, people getting it out of their systems. And this rhetoric and sentiment has really just changed and flip-flopped throughout the year. Generally speaking, though, as we go through these names, you'll see a bit of a trend of the kind of stocks that are up and the kind of stocks that are down. So I just want to start here with Airbnb, up huge on the year, about 50%, over $80 billion in market cap. Their PE is not accurate there because of a tax event. So we'll go over their real price to earnings ratio later in this segment here. But overall, the company's been doing really well. They recently reported their third quarter earnings. You can see here revenue up 18%, net income up huge as well. Looking at their EBITDA up over 25%, so outpacing revenue growth. Free cash flow as well up huge. They did just under $1 billion in Q3 last year, now at $1.3 billion, so over 30% free cash flow growth. And their trailing 12-month margin on free cash flow is 44%, which is extremely good scale on their revenue. And as they continue to grow their revenue, they've seen that tick up as well, which is great to see. So firing on all cylinders, really strong double-digit growth across their business here. This is their trailing 12-month free cash flow just compared to the prior periods. You can see back before the pandemic, this company was just still in high growth mode, but not really overly profitable, just a couple $100 million in free cash flow. Fast forward to last year, did over $3.3 billion on a trailing 12-month basis. And then in the trailing 12 months this year, did $4.2 billion in free cash flow. So that is a ton of free cash flow that they're generating to invest back in the business, new growth opportunities, keep revenue growth growing, which is falling to the bottom line really nicely in terms of cash flow, as you can see by that 44%. So they're doing pretty strong here. Looking at some of their other charts, on top line revenue, you can see similar story. They were growing at 30% back before the pandemic, but they're still growing pretty high teens despite having a base that's more than double the size on absolute revenue. So really well done on that front from Airbnb. Taking a peek at their balance sheet here, just comparing versus a year ago, you could see their total current assets up pretty nicely from pretty much 15 billion to 17.5 on current assets, on total assets up to 21 billion, up from 16 billion last year. Looking at their liability here, their liabilities are up slightly. So total liabilities from 10.5 to about 12 billion. The good thing, though, is that their assets have outpaced their liability growth. And if you look at their liabilities or their net debt on a multiple of their EBITDA, they're actually in a much healthier position now than they were last year because of their business has grown so much. So in terms of what the stock's trading for right now, $130 a share. This year is not really too accurate because it's including a tax event that took place that diluted or improved their EPS artificially. But from what I saw, they were kind of closer to $3.50 earnings per share this year. And for next year, it's just over $4 is their average estimate. So $4, they're trading at about 31, 32 times next year's earnings here. With that being said, you can see the wide range. Some analysts are calling for almost $6 in earnings per share, which would get the company to kind of that 22, 23 times multiple. On the low side, $3.30, which is more of a 45 times multiple. So you can see here, not really a similar story, or different analysts have different points of view here, and it's a lot of room for error in the middle between what they are anticipating. So that kind of just paves the way for potential increased volatility even in the future as we look over the next 12 months, as it's not really a consensus of where earnings are going to fall on Airbnb. Going into the second travel-related stock, it is Expedia. Expedia, very interesting company here, much smaller market cap, under $20 billion. Looking at this company in the last year, stock's up 36%. You can see more than all of that has happened in the last few weeks here, as it's rallied almost 50% in the last month. And there's a couple of reasons for that we're going to talk about in this video. But just as a starting point, good to know that this company is less than a quarter of the market value that Airbnb is. Looking at their metrics here, so you can see booked room nights up 9%, gross bookings up 7%, revenue up 9%. So not up the same extent as Airbnb. Airbnb has a bit more growth tailwinds as they're still expanding to new markets and whatnot, but still pretty good growth, high single-digit growth there. Where we start running into issues is on operating income, net income, but it seems like there may be some one-time event, because when we look at adjusted EBITDA, pretty strong, up 13% as well, and net cash used in operating activities minus 1.4 billion, cash flow minus 1.5 billion. So it seems like they've been investing in their business and some things, or potentially not sure if they take share buybacks out of the free cash flow number before it's adjusted there. But you see here, they bought back $1.8 billion of shares so far this year. And that's a continuing story. They think their business is underpriced. And you can look that the shares actually jumped 18% after they announced that 9% revenue increase, but probably more notably, the stock buyback program is massive. The board approved a $5 billion share buyback purchase. And remember, this company's only worth $19 billion. So if they actually go through with buying back 5 billion shares in the next year, which they may not, but even if they do a good chunk of that, that's a quarter of the company that they're buying back for shareholders. So it will be really interesting to see if they're able to do that or how much they're able to do. I doubt they can do that much in a year, but maybe they do 2 billion, 2.5 billion. Even that would be massive in lowering the share count and increasing every investor's stake in the company. Taking a look at their assets and liabilities here on their balance sheet, you can see here current assets up nicely from the prior periods. Total assets up 22.5 billion, higher than it was in the prior periods as well. On the liability front, just taking a look here, total current liabilities up as well. So maybe they took out some cash and that's feeding in their assets, but coming out of liabilities. But overall seems somewhat healthy, maybe a bit higher on current liabilities than I'd want for a company that is an $18 billion market cap. But overall, I'd say this company is significantly lower valued than Airbnb, despite still growing decently, right? So definitely not as sexy of a name, but it's definitely reflected in the multiple. You can see here they're expected to do about $10 of EPS this year, so trading at about 14 times this year's earnings. Next year, going up to $12 of EPS, which gets them to about 11.5 times. So this is trading at a much cheaper valuation than Airbnb. If you're a value investor, or not a value investor, but if you like companies trading at lower price to earnings that don't necessarily need to grow into it as much, this may be a company for you. They also own Vrbo, which, while not close to the size of Airbnb, is kind of like an Airbnb competitor. The third stock here is Wyndham Hotel and Resorts. So Wyndham owns a ton of hotel chains. We're going to get to it in a second here. The stock's been up over the last few months as there's been rumors that Choice Properties is continuing to try to acquire the company. The board of Wyndham's been fighting them off. They don't really want to be acquired. So we'll see how that all nets out. But that's kind of driven some share price appreciation in the short term. But over the long term, they've done a really good job of creating value on this one, up over 55% in the last 5 years here, which is great to see. They also paid a little dividend of about 2% there, $6.5 billion market cap. You may say, how are we getting all of these brands, all of these hotels for just $6.5 billion? The reality is they don't actually own any of the hotels. They purely license it to small businesses who are operating it and kicking them back royalties in order to operate the brands. So that's a really asset-light business model. They just get checks every month from all of their franchisees whenever you see one of these brands in action in vacation destinations or off the highway. You can see here that a ton of their business, and it's even underrepresented by this picture because lots of their locations are in these economy mid-scale hotel chains. So that's really a big percentage of their business. You need to know that you're really investing in those economy mid-scale hotel chains if you're investing in Wyndham. They are trying to build their upper mid-scale, upscale offerings, but today lots of their hotels are still in this economy and mid-scale range. Looking at just where they have their rooms, you can see here the US isn't, they're very penetrated in the US. Their system's not growing as much as outside. So about 500,000 rooms in the US. That's barely up, just up about 3,000 versus last year. Whereas internationally, they're growing at a much faster pace, about 5.5% growth. 362,000 rooms up from 343,000. So they gained about 20,000 rooms there. Overall, pushing 1 million rooms in their network currently. Looking at some of their priorities for this year that they've called out. First one is drive net room growth. So to drive net room growth, they have a development pipeline where they're partnering with franchisees or builders to build these hotels and then sell the hotels to people who will franchise them for them on long-term deals. They're also looking to increase owner profitability. The reality is when lots of people buy these hotels, these small businesses, like a Motel 8 or whatnot, they cost $10, $20 million sometimes, and most people don't have that much money to put down. So they get financing, and with interest rates as high as they are, it's probably put a huge dent in profitability of their franchisees. And at the end of the day, if the franchisees aren't making money, if it's not economical for them to be operating, it really does impact the amount of demand that there is for these businesses and for them to open up new franchises. So they're really focused on how can they better drive profitability for their partners. So then more people want to become partners and those partners want to open up new hotels. And that just kind of feeds the cycle and the feedback loop of growing the business here. So that's their second priority, which I think are the two right places to have priorities. In addition to development, they also can drive net room growth by signing up hotels that are currently not affiliated with a brand or maybe affiliated with a competitor brand through many different means as well. So it's not just necessarily building up new hotel chains. And I mentioned the stock price going up a bit because of Choice Hotels trying to acquire them. This is just an example of them kind of alluding to why they think they're better off alone. They think that if they do get acquired by Choice, it may impact financing on some of their new brands like Echo Suites that they're trying to build out, which is a long-term stay brand. Some of their new developments, some of the franchises have mentioned they don't want to be owned by Choice Hotels because they feel like they just treat them like they're just a number more so than a business partner, and they just care about their profitability, whereas Wyndham is a bit more focused on them. So lots of these risk factors that they're calling out. I'd say as I scroll through some of these slides, whenever a company doesn't want to get acquired, if that's the stance that they take, they always put together these kinds of things and share this kind of message to their investors to try to get them on their side. So, sometimes this is just politics and how it works when a company doesn't want to get acquired and they make the numbers work or get the quotes that make their story work. But overall, it will be interesting to see how this one plays out. One way they've really been strong at returning capital to shareholders is through share buybacks. The company used to have 100 million shares, and today they just have 85 million. So over the course of the last 5.5 years, they've bought back 15% of the company really, really consistently and sequentially, which is really great to see. Even though they only pay that 2% dividend, they are giving you back pretty much 3% in share buybacks on average as well. And when we look at a multiple here, expected to do about $4 of earnings per share this year. So despite the stock getting bid up behind the potential Choice Hotel acquisition, company's still trading at under 20 times earnings, forward looking, trading closer to 19 times earnings, as they're expecting about 6-7% growth there. On to the next travel related stock. It is Southwest Airlines. And what you'll see in this video is while lots of the hotel and hospitality chains have been going up in value, the airlines are getting crushed. So Southwest here down 50% in the last 5 years. Lots of that's COVID related as well. But even in the last 1 year, 36% down. Just the combination of people having already traveled a lot a few years ago, paired with the price of gas, paired with some of the wars we got going on in the world. When you own Airbnb or a hotel chain that's primarily in the US or other sunny destinations, you get kind of shielded from the cost of oil and gas from some of the regions of the world that have wars going on. But it's no getting away from it when you're an airline and you can't fly over certain areas of the world, or you lose hubs in certain cities or certain countries. Sometimes certain countries affiliated with those countries at war will limit American planes going in and out. It goes on in terms of the complications. But in addition to those two things, airlines have also dealt with extremely high increases in wages for pilots, which is obviously essential for their operation. So you see here, Southwest Airlines down 36%, pays a nice 3% dividend yield there. Looking at their business a bit, they had net income of a couple $100 million or 30 cents a share last quarter. They have good liquidity, $12 billion. They do have outstanding debt of $8 billion. So looking at their market cap of 14.5, it's a good chunk of debt for them. Probably haven't paid off all of the pandemic debt yet on this name. And one of the things that's interesting to see is this company primarily, I believe, flies from within the US to southern locations. Think Florida, think Caribbean and whatnot. And they're really focused on driving scale in the hubs that they do fly out of. They want to be the top market share airline in the markets that they do fly out of. And they're doing a pretty good job of that. You can see the blue and the yellow dots on the screen represent strong market shares across their business. They also have an entire Boeing 737 fleet and some of the other areas that they're looking at concentrating on to differentiate themselves and just drive efficiencies and synergies throughout their operation. At the end of the day, they're expected to do about $1.50 in earnings per share this year. So trading at about 16 times earnings here. Really expensive, in my opinion, for an airline stock. But I think Southwest may be a bit more defensive than some other ones, not as reliant on business travel, not as reliant on international, but still 16 times it looks like to be quite a multiple for an airline, in my opinion. Going on to the next one here, we got Marriott. Marriott, $61 billion company here. So a massive business, up 30% in the last year, similar to some of the other hospitality stocks. You can see a nice little run up in the last few weeks, up 12%. If we look at their dividend yield, they're paying out 1%, which is something at least in terms of a dividend. And similar to Wyndham, they own tons of brands, except inversely to Wyndham, lots of those brands they own are on the more upscale, mid-scale, premium side of the equation. The Ritz-Carlton, St. Regis, Luxury Collections, W Hotel, JW Marriott, Westin, etc., etc. 4 Point Sheraton's probably one of their more mid-tier ones, but they own tons of brands that you guys are all probably familiar with all over the world here. Looking at their performance, you can see their gross revenue for the year, just under $5 billion is what they're expecting. And then their adjusted EBITDA is $4.5 billion. So similar to Wyndham, they pretty much license or franchise all of their resorts, which means that out of almost $4.8 billion in gross revenues, they have $4.5 billion in EBITDA, just crazy margins because they have an asset-light business model. Earnings per share of about $8.50 is what they're calling out for the year. And they return over $4 billion of capital to shareholders, which is phenomenal for a $60 billion mature company, probably doing tons of share buybacks as well. Some facts about their last quarter: their RevPAR, which is like revenue per average room night, up 9%, 4% in North America, 21% in international markets. That's similar to some other hotel companies as well. You can see here they repurchased $4.8 million of stock for $1 billion in the quarter. So that's probably where lots of their returns of capital to shareholders are coming from. You can see here $3.7 billion this year. So that's massive in terms of the amount they're buying back. Really interesting to see that. In terms of their earnings per share, like they said, analysts are expecting about $8.50 this year. But what's really interesting is they're expecting closer to $10 next year. So the stock right now is trading for 21, 22 times next year's earnings, closer to 25 times current year earnings. So definitely not a cheap stock. Trades a bit cheaper than Airbnb, trades a lot more expensive than Expedia. So it just depends where in the travel space you want to be exposed to. Do you want to be exposed to a hotel chain? If so, do you want it to be a premium hotel chain like Marriott or a discount value one like Wyndham? If you don't want to be in the hotel chain operation, but you want to be in the home sharing business like Airbnb, you can pivot that way, but you have to pay up. Or if you want to be in airlines, it's a completely different game. Talking about airlines, we're going to wrap up here with Air Canada. It's a nice little contrast versus Southwest because they have very different valuations here. You have Air Canada here down 6% on the year, so not down as much as Southwest for starters. But when you look at the valuation, $6.3 billion value on this company. Looking at their business here, you can see their business has grown very nicely in the last first 9 months of the year. $15 billion of revenue on passengers versus $10 billion a year ago. Overall, 16.6 versus 11.8. So really strong growth. Operating expenses have also grown to some extent, but they're expected to make almost $6 of EPS this year, just in that 9-month period. And the share price is at $17. So that's why the PE here is so low. I think they may have a tax correction coming up in the last quarter because you can see here on the year they're expecting just $4.50. But even at $4.50, the stock's trading for about 4 times this year's earnings. With that being said, you can see a huge decline expected for next year. So 4.5 down to 3.5, about 25-30% reduction in earnings per share. And I think that's primarily driven by some of the things that we've recently talked about on Southwest. Pilots getting more expensive, gas getting more expensive, geopolitical issues are taking a bit of a toll on the business. In addition to that, we're starting to see airfares decelerate. I think October was down 15% versus last year in Canada. So we have all these costs going up. We have revenue outlooks going down, and it's squeezing that EPS down. So it'll be interesting to see how it pans out. Even at $3.50 per share, if they can maintain that over the medium term, that is only about 5.5 times earnings on Air Canada, which comes with the next issue on these airlines, which is debt. So we'll see here the debt. I really like how they break it out here. $12 billion of long-term debt, down from $13.5 billion last year at least. So they've been paying off some of their debt. Another thing that they kind of call out here, which I don't really count as debt, but they have to classify it, is their long-term lease requirements. So this is just all of the money that they own on, their office buildings, maybe other warehouses they own, stuff like that, and aircraft that's rented. So you can kind of see their rates. It's interesting to see 8% rates there, 9% rates here. Some of these with 4.6% rates, you can see they didn't pay any of it off. So it's interesting to see quarter over quarter what they're paying down, what they're not, and some of it has common sense to it, some of it doesn't, and I'm sure it's reasons behind it that are rational, but interesting to see the breakdown of their debt. At the end of the day, having $12 billion of debt for a company that did $15 billion in the first 9 months and is only worth in aggregate $6.3 billion is a lot of debt. So they're still trying to pay down that debt as they're kind of facing these revenue headwinds and cost accelerators. And I think that's why the valuation on this one's gotten squeezed so much. But I do think that if they're able to get their way out of this situation and continue to pay off their debt, continue to be profitable, if interest rates start trending down, they're going to have a huge multiple expansion as they get a better debt to EBITDA ratio. And this company has the potential to, go up a lot in terms of the equity value. So a bit of a riskier play, but I wanted to add it to the list as well. Back before the pandemic here, you can see they were closer to $50 a share. Okay, hope you guys like this content. This was 6 travel stocks to consider buying. If you do like this kind of content, be sure to give this video a big thumbs up, and I will see you guys in the next one. Thanks.